Here's a question I want you to sit with for a second. If you do everything right, you work hard, you save, you buy a home, you top up your super, will you actually be wealthy by the time you retire? Because the maths says, probably not. And I'm not talking about people who blew their money on takeaway and holidays. I'm talking about the genuinely responsible Australians, the ones doing everything their parents told them to do, who are quietly falling behind and have no idea why. Today, I want to walk you through what I call the wealth trap, the system that was designed to make you feel financially responsible, while actually keeping you from building real, lasting wealth. And the scariest part? The trap was set before you were even born. Let's go back to the script. You know the one. Study hard, get a good job, buy a house as soon as you can, pay it off, put money into super, retire comfortably at 65. For your parents' generation, that actually worked. In 1985, the median house price in Sydney was around $85,000. The average full-time salary was about $22,000. So a home cost roughly 3.9 times the average annual salary. Fast forward to today. The median Sydney house price is pushing $1.4 million. The average full-time salary is around $98,000. That's now 14 times the average salary. Same strategy, radically different maths. And here's the thing nobody says out loud. The advice didn't update. The system didn't update. But the numbers completely changed underneath your feet. So the question isn't whether you're doing the right thing.
The question is whether the right things still work. Let's start with the big one, the Australian dream, the house. Now, I want to be really clear here. I'm not saying don't buy a home. Owning the roof over your head has real value, and for many people, it absolutely makes sense. But what I want to challenge is the idea that your home is your primary wealth-building vehicle, because the maths just doesn't support that anymore. Here's the scenario. You're a couple in Melbourne, combined income of $160,000. You've saved hard and scraped together a $120,000 deposit, which in today's market, that's a 10% deposit on a $1.2 million home. So you take out a $1.08 million mortgage. Now, at today's variable rates, let's say you're paying around 6.2% interest. On a 30-year mortgage, your monthly repayment is roughly $6,600 a month. That's $79,200 a year just in mortgage repayments. But here's the part people gloss over. In year one of that mortgage, around $66,000 of that $79,200 is just interest. Pure interest. You're paying the bank $66,000 a year just to hold the loan. The actual debt is barely moving. Over 30 years on that $1.08 million mortgage, you'll pay back approximately $2.39 million in total, meaning the interest alone costs you more than the original house price. Now, yes, property prices do generally rise over time, and yes, you need somewhere to live, but are you building wealth? Or are you servicing a debt so large that it crowds out every other financial decision you'll make for the next 3 decades? And while you're doing that, every spare dollar going into the mortgage, what are you not doing? Investing. Okay, so maybe property is the anchor, but surely super is the safety net, right? Well, let's look at the numbers. The current superannuation guarantee rate in Australia is 12%, meaning your employer puts 12 cents of every dollar you earn into your super fund. Now, for most Australians, super is sitting in a default balanced fund, which sounds fine. Balanced, safe, responsible. But here's what a balanced fund actually looks like. Roughly 60 to 70% growth assets, Australian and international shares, property, and 30 to 40% defensive assets, bonds, cash. The long-term average return on a typical balanced super fund is around 7 to 7.5% per year, And importantly, that's already after fees and taxes. Now compare that to a simple low-cost international index ETF. The Vanguard MSCI Index International Shares ETF, one of the most basic investments you can make, has returned an average of around 10.5% per year over the last decade. That difference of 3 to 4 percentage points sounds small, but over 30 years it is anything but small. Let's put some numbers to it. Say you're 30 years old and have $50,000 in super today. You contribute $10,000 per year for the next 35 years until you're 65. At 7% average return, the balanced fund after fees, you retire with approximately $1.92 million. At 10.5% average return, closer to a growth or index option, you retire with approximately $4.69 million. Same money, same contributions. That's a difference of over $2.7 million just from the investment option you're sitting in by default. Now, I'm not saying super is a scam. It's not. It's a tax-advantaged forced savings vehicle, and it's better than nothing. But the default settings are quietly costing millions of Australians hundreds of thousands of dollars in retirement wealth, and most people have no idea. And then there's income, the third leg of the traditional wealth stool. Work hard, get promoted, earn more, repeat. The problem is, wages in Australia have not kept pace with the cost of living. According to the ABS, real wage growth in Australia, that's wage growth adjusted for inflation, has been essentially flat or negative for much of the past decade. Wages have grown, but prices have grown faster. And the tax system amplifies this. In Australia, every dollar you earn above $45,000 is taxed at 30 cents. Above $135,000, 37 cents. Above $190,000, 45 cents. So to get a $10,000 improvement in your actual take-home pay at a middle income,
you need a $14,300 gross pay rise. And if you're earning above $135,000, you need closer to a $15,900 raise just to see $10,000 extra in your pocket. Meanwhile, your mortgage is growing, your grocery bill is growing, your energy costs are growing, your rates are growing. The salary treadmill is real. And here's the brutal truth. You can't earn your way to wealth in Australia if you're only relying on a salary. The tax system and cost of living make that nearly mathematically impossible past a certain point. The people building serious wealth in this country are not doing it by getting a bigger salary. They are doing it by making their money work harder than they do. So what does the alternative actually look like? I want to be clear here. This isn't some secret only available to the rich. This is basic financial mechanics that just doesn't get taught at school. Step 1. Understand what an asset actually is. An asset is something that puts money into your pocket without you having to show up to work. Shares, ETFs, investment properties that generate rental income above your costs, businesses, these are assets. Your home, as we discussed, is not an asset in the traditional sense unless it's generating income. It's a liability with potential upside. Step 2. Start investing in broad market index funds as early as possible. This is not glamorous, it is not exciting, but the compounding maths is almost offensive. If you invest just $500 a month from age 25, that's $6,000 a year, into a broad global index ETF averaging 10% annual returns, by age 65, you have approximately $3.16 million. The total amount you actually contributed? Just $240,000. The market did the rest. $2.9 million in returns on $240,000 of your own money. That is the power of compound growth over time. Einstein reportedly called compound interest the eighth wonder of the world, and when you see those numbers, it's hard to argue. Step 3. Optimize your super. Don't just set and forget. Log into your super account this week. Check what investment option you're in. If you're under 40 and you're in a balanced fund, seriously consider switching to a high growth or international shares option. The long-run maths almost always favours growth assets for younger investors. Step 4. Build income streams outside your salary. Dividends from shares, distributions from ETFs, a side business, rental income. These don't have to be huge. Even $500 a month in passive income changes your psychology and your financial position dramatically. The goal is simple. Over time, build a situation where your investments are generating as much income as your job. At that point, you have choices most Australians never get. Here's what I think is the most important thing I can leave you with today. The traditional path isn't wrong because your parents lied to you. It worked for them because the numbers made sense. But you are playing a different game now, on a different board, with different rules. The house prices are different. The wage growth is different. The interest rates are different. If you keep playing by 1985 rules in a 2025 economy, the maths will not save you. But the beautiful thing about this moment, and I genuinely mean this, is that you have access to tools and investment products your parents could never dream of. Low-cost index ETFs, fractional shares, micro-investing apps, high-interest savings accounts, self-managed super. The barriers to wealth building have never been lower. The wealth trap is real, but it's only a trap if you don't see it. So, to recap, the 3 pillars of the traditional Australian wealth plan, the house, the super, the salary, are not broken, but they are no longer enough on their own. The maths has changed, and the strategy needs to change with it. And if you found this video useful, the single best thing you can do is leave a like. It genuinely helps this video reach more people who need to hear this. I'll see you in the next one.